Do you want to buy real estate? Well, if you're like me and a lot of my readers of my new book, The Millionaire Zone, the answer is probably yes. But in today's cautious market, real estate is a far cry from a sure thing. You know, if you're buying investment property, it's only the beginning because you've got to manage it, find renters, and deal with those expenses. And I know it, owning a bunch of real estate myself. And how much diversification do you get? Well, you don't get a whole lot unless you can afford to buy, of course, more properties. And are professionals running the show? Well, maybe to collect the rents, but not to make those decisions. And you can buy those special properties like a Four Seasons hotel or an upscale assisted living facility, but do you really want to own those things? Well, enter the Real Estate Investment Trust, or the REIT. Now, REITs are investment companies, and as such, they manage a portfolio of real estate investments. Here's the really interesting thing. They're required by law in order to avoid corporate level taxation to pass on 90% of their earnings to you. So REITs by nature are income investments. In fact, REITs average about a 5 to 6% average annual yield, sometimes more, and there is growth potential because properties, as we know, appreciate and rents keep going up, up, up. Now, we like the combination of income and growth potential, don't we? Yes, we do. Well, collectively, REITs were up some 35% last year. God, that's a lot. And by the way, they did quite well during the 2001-2002 market downturn. Some of last year's gains were spawned by private equity takeovers like, you may have read about it in the paper, Blackstone's recent $20 billion capture of Equity Office. Now, I like to follow the smart money. At least some of it is going into REITs. Now, as the REIT universe is becoming larger and more diverse, I think many investors, especially those seeking yield, are headed this way. But the hard part is, how do you choose among the some 200 REITs out there? It's not easy. They don't get as much press coverage, nor as much coverage in financial and brokerage sites as we might like. So as a result, the research process is quite cumbersome. In a moment, I'm going to give you some specific ones. But what I did is I divided my time between the Yahoo Finance Industry Browser and the National Association of Real Estate Trusts, or NAREIT, website. Both give you scattered summary data, but you'll find that they're going to get you to most REIT company websites pretty quickly. Now, it's handy to know that REITs are grouped into 6 different categories: hotel, motel, residential, industrial, office, healthcare, and diversified. My list of favorites draws on some of the more creative and undiscovered portions of the REIT space. So let's take a look. The first one is Prologis. And by the way, its ticker is PLD. It's part of the diversified REIT group, and indeed they are. Boy, they've got warehousing, logistics centers, and part of their business helps its customers define and develop new logistics capabilities. I also like the mixed-use development branch of their business, which has brought some high-visibility projects like Mission Bay in San Francisco. Here's another one, Healthcare Realty Trust, ticker is HR on the NYSE. It's hard to argue against demographic trends, and demographics suggest that investors should have at least some of their portfolio aligned to healthcare, with all those retirees and baby boomers retiring. HR and others like it play in the real estate occupied healthcare providers area, specifically medical office buildings and outpatient care centers, which of course just skyrocketing with higher populations. There are lots of other choices in the space. Many also offer assisted living and other long-term care arrangements. Number 3, Strategic Hotels and Resorts, BEE is its ticker. You'll also recall I like plays in the luxury space, as though well-heeled are growing in numbers and they're probably not going to stop spending money anytime soon. Well, BEE owns and operates a top-tier group of properties, including the Ritz-Carlton Half Moon Bay and the Hotel del Coronado in San Diego, and about 20 others. A trip to the website reveals a very together and strategically minded outfit, and the yield is among the strongest in the hotel-motel group. Here's another one, Digital Realty Trust, ticker DLR. Here's a creative idea. Buy inexpensive warehouse and industrial properties near city cores and convert them into data centers. DLR does exactly that, bringing high-end rents to low-cost investments. Very smart strategy. Corporations are working to get data centers out of high-cost, vulnerable central spaces. They should work well for DLR. Well, REITs are long-term income-oriented plays with some growth characteristics. I like that they track key demographic and economic trends. That said, REITs are hard to pick and they're vulnerable to headline risk as the tide goes out in certain parts of the real estate industry. But I still think now is a pretty good time for you Millionaire Zone readers of my new book, it's a great book, to do some REIT hunting for your portfolio. I'm Jennifer Openshaw.